What if insurance was never really about your accident, your house, or your death, but about something else entirely?
Insurance feels simple. You pay a little every month, and if something bad happens, they cover it.
Walk into any insurance company's office and it looks almost boring. Desks, spreadsheets, nothing dramatic happening at all. But here's the truth. Insurance companies aren't really in the business of paying money when disaster strikes.
They're actually one of the quietest, most profitable industries on the entire planet, and not for the obvious reason.
The real secret isn't clever pricing, or even denying claims aggressively. It's something far stranger than that.
One legendary investor built a $750 billion empire almost entirely around one insurance concept. That concept is called float, and once you understand it, insurance stops looking like simple protection.
It starts looking like the biggest, quietest investment fund hiding in plain sight this entire time.
Insurance doesn't really sell you protection, the way a locksmith sells a lock for your door. It sells a promise instead. A promise funded almost entirely by money it already collected earlier. Premiums come in today. Claims usually get paid out months, sometimes years, or even decades later. Think of every insurance company less like a safety net and much more like a hidden investment fund. In that gap between collecting and paying, something quietly powerful happens to all that money.
The insurer gets to invest it, nubhid, every single dollar iki nutid, for its own benefit, right now.
This pool of money even has a specific name inside the industry. Insurers simply call it float.
Once you see float, you stop asking, how much do they pay out, and start asking something else.
Rewind to 1688. Inside a London coffeehouse owned by a man named Edward Lloyd, near the docks. Ship owners and merchants gathered there, worried their cargo might sink somewhere out at sea. Wealthy individuals in the room agreed to cover the loss, in exchange for a small upfront fee. That's how Lloyd's of London was born. Oh, a coffeehouse, deals on the tables, insurance done by handshake. By the 1700s, insurers realized something crucial. They needed real numbers, not just educated guesses. Enter the actuarial table, THREED, a systematic way to calculate exactly how likely disaster actually is. How many ships sink each year? How many people die at each age? Real, calculated probabilities. Suddenly, insurance wasn't gambling anymore. It became a business built entirely on cold, hard mathematics. One person's house might burn down. But across 10,000 houses, the pattern stays eerily reliable. Insurers realized that if you pool enough people together, individual risk becomes remarkably predictable overall. That's the entire foundation of insurance. Risk becomes math the moment enough people pay in. It starts with something called underwriting, deciding exactly who to insure and how much to charge. So how does a modern insurer turn thousands of individual premiums into one giant investable pool? Underwriters look at your age, your health, your driving record, your zip code, everything measurable. The riskier you look on paper, the higher your premium climbs, sometimes dramatically higher overnight. But underwriting isn't really about protecting you specifically. It's about protecting the accuracy of the pool. If risky people get charged too little, the whole float model quietly starts falling apart. So insurers spend enormous resources making sure the math stays balanced, year after year after year. Once your premium is set, you pay it, and the insurer books that money right away. But that money isn't sitting in a vault somewhere, gathering dust, waiting for a rainy day. It gets pooled together with millions of other premiums into one enormous, constantly growing account. That growing account is exactly what we mentioned earlier. This enormous pool is called the float, and float isn't small change. For one company, Alush, it recently topped $170 billion. That's $171 billion sitting there, waiting, available to be invested right now.
Back in 1970, that same company's entire float was only $39 million. Barely anything.
50 years of collecting premiums, reinvesting the float, and compounding turn that puddle into an ocean.
Now here's the part that actually makes float dramatically better than borrowing money from any bank.
But when an insurer underwrites carefully, its float can actually come with a negative cost. Negative cost means Essentially, policyholders are quietly paying the insurer to hold their own money.
That's the exact opposite of every other loan you've ever encountered anywhere in your entire life.
One legendary investor called this exact idea better than free money. It's genuinely hard to disagree. So the entire game becomes obvious. Collect as much float as possible and never let it cost anything. It bought a small insurer back in 1967 and used its float to buy other companies entirely. It kept acquiring more insurers, each one adding its own float into one giant shared pool. This company posted an underwriting profit for 14 straight years, totaling $28 billion in gains. That combined float became the engine of funding decades of stock purchases, acquisitions, and long-term investments.
But here's the strict rule underneath all of it. The float only works if underwriting stays disciplined.
That means it made money twice, once from underwriting itself, and again from investing the float.
Most insurance companies never manage that double win. They usually lose money on underwriting alone. Across the wider industry, premiums collected have often fallen short of covering claims plus expenses combined.
So how do most insurers even survive that gap? The answer, again, comes back to float.
There's a specific number that measures whether insurers are winning or losing on underwriting.
It's called the combined ratio. Add up all claims paid, plus every operating expense, then divide by total premiums collected. Simple formula.
Below 100% means an underwriting profit. Above 100% means an underwriting loss. They don't panic though, because the float sitting underneath quietly covers the shortfall, and then some.
Most car and home insurers actually operate above 100%, technically losing money on underwriting alone.
This is why insurers can seem to lose money on paper, yet still report enormous profits overall. They don't panic though, because the float sitting underneath quietly covers the shortfall, and then some. Now let's talk about the other lever insurers pull constantly. Claims tube, specifically, which ones actually get paid.
Health insurers in the US denied around 1 in 5 in-network claims in one recent year alone.
That's nearly 9 million denied claims out of 46 million submitted in just one data set.
Some insurers denied as many as 1 in 4 claims submitted by their own paying members. And here's something surprising. Most denials aren't even about medical judgment at all. They're about paperwork, a missing code, a missing signature, a form filed one single day past the deadline. Every denied claim delays a payout, which means that money stays inside the float just a little longer. But when people actually do appeal, the numbers get genuinely surprising. Many denials get overturned entirely. In one major program, over half of all initial denials were reversed once someone actually appealed. That gap between denial and appeal isn't an accident. It's friction, deliberately built into the process. Reworking just one denied claim can cost real money, sometimes over $100 each time.
Multiply that friction across millions of claims, and denial itself quietly becomes its own profit center.
Let's step back to the math itself. How does an insurer decide who even gets a policy?
There's a hidden danger insurers constantly worry about. It's called adverse selection, and it's genuinely serious.
Sick people want insurance more than healthy people do. That imbalance alone can quietly break the math. If only risky people join the pool, premiums must rise, pushing even more healthy people away.
That downward spiral has an actual name too. Economists call it, quite bluntly, the death spiral.
If only risky people join the pool, premiums must rise, pushing even more healthy people away. Now, some risks are simply too enormous for any single insurer to safely hold on its own.
Mandates, workplace coverage, and automatic enrollment all exist partly to keep healthy people paying in too.
That's where reinsurance comes in. Insurance companies quietly buying their own insurance, just in case.
A hurricane, a pandemic, an earthquake, Konchin. Reinsurers help spread that risk across the entire globe.
When a disaster becomes too large for one company, reinsurance is the safety net underneath the safety net. This layered system is exactly why insurers rarely collapse from just a single storm or disaster.
A handful of giant reinsurance firms quietly stand behind almost every major insurer you've ever heard of. So where does all that float money actually get invested? Mostly safe, boring assets, quite deliberately. Even the float itself gets partially reinsured, spreading both the risk and the reward more broadly. Bonds, high-grade corporate debt, sometimes real estate projects. Insurers rarely gamble with their policyholders' money. The goal isn't wild, dramatic returns. It's slow, steady, dependable growth stretched out over years.
Even a modest 4 or 5% annual return on billions of dollars adds up enormously.
Compound that return, year after year, decade after decade, and float becomes a genuine wealth machine. This is exactly why insurance companies love long-tail policies. Covernout, coverage that pays out decades later.
Life insurance, workers' compensation. Certain liability claims can take literally decades to fully settle. The longer the delay between collecting and paying, the longer the insurer gets to invest that money.
That's not a bug in the system. It's genuinely the entire point of the whole business model.
But this whole beautiful machine has one serious weakness. It genuinely cannot survive constant, catastrophic surprise. In 2008, one massive insurer nearly collapsed the entire global financial system almost overnight, single-handedly. That insurer hadn't just sold traditional policies. It had sold complex financial insurance nobody fully understood. The US government had to step in with an enormous bailout, just to prevent total collapse.
The lesson wasn't that insurance itself is fundamentally broken. Insurance, done carefully, actually works remarkably well.
When housing prices collapsed, those hidden obligations all came due, at once, simultaneously, everywhere, at the same time. The lesson is that float, unmanaged and reckless, can just as easily become a hidden liability.
Climate change adds a newer, faster-moving threat too. Hurricanes and wildfires are growing more expensive every single year.
In some high-risk states, insurers have simply stopped writing new home policies altogether and walked away. When the math stops working, insurers don't take the loss quietly. They simply exit the market. That leaves homeowners scrambling for coverage, sometimes paying triple the price through a last resort state plan. So why do people keep buying insurance, year after year, even when they rarely ever file a claim? Part of it is genuine fear. Nobody wants to imagine the worst-case scenario actually happening to them. Part of it is simply the law. Car insurance, for instance, is legally required in most places. And part of it is smart, deliberate marketing. Mascots, jingles, friendly agents who feel like neighbors.
Every insurance advertisement sells the exact same core promise: peace of mind, not raw statistics.
The moment you actually buy a policy, you're really paying for a feeling as much as protection.
So let's put every single piece of this machine back together now, one more time, completely. Premiums collected today. Careful underwriting. Actuarial math keeping the whole risk pool perfectly balanced. That premium money becomes float, a massive, patient pool waiting quietly to be invested somewhere.
Claims, meanwhile, get delayed by friction, paperwork, and denial tide, keeping that float growing just a little longer. Reinsurance quietly spreads the biggest risks across the globe, protecting the float from any single disaster.
And underneath every part of this system sits one constant, fragile risk: catastrophic, unpredictable, all-at-once surprise.
Insurance never really sold you protection from disaster. It sold you a very patient investment vehicle, one that happens to be funded, entirely and completely, by your own fear of the unknown. You're not just buying safety. You're quietly funding one of the biggest investment machines on Earth.
So the next time you pay a premium, remember exactly what's actually happening behind that payment.
So what does all of this actually mean for you, sitting there paying your own premium every month? It means your deductible size directly decides how much friction stands between you and your payout.
It means every question on that intake form is quietly measuring your risk, not just checking boxes.
It means a denial usually isn't personal. It's a numbers game, repeated at scale, across millions. It also means appealing is worth it. And remember, More than half of denials get overturned. New parametric policies now pay out automatically the instant a sensor detects the disaster itself happening. The industry itself is changing fast too. AI now underwrites policies in seconds, using far more data. No claims form, no adjuster visit, no waiting, just an instant payment, triggered entirely by data. That could make insurance faster and fairer for everyone, or it could just make it float grow bigger.